Morning, friends. Today we have two stocks in the railway sector that are on the news and on the cards. One of them is Ircon International. It's a PSU specializing in large and technological complex infrastructure projects in various sectors, such as railways, highways, etc. Established in 1986. Total order book highest in FY22 was 43,758. This has been constantly sliding downwards. FY23 25,000, FY24 20,000, yeah, from 25 to 20,000, and currently it is down to 20,000. So overall, you can see there is a downward trend in the number of orders that the company has got. The highest being apart from them is the railway segment. The highest 26,000 crore order it had in FY22, and now it is down to 15,000 crores in FY22 25. The highest still among the core business for Ircon International is the railways. However, there is a reduction in the order book by about 11,000 crores over the last 3-4 years. So this demonstrates poor growth or negative growth over the last 3 years. This is another stock called Texmaco Engineering and Services. Nuvama have recommended this as a buy for an upside of 25%. It's a buy call, target of 331 rupees. So currently trading at 175. Uh, just a moment. Yeah, so Texmaco Rail. I don't know how. Sorry, there's some type of graphic error. Wednesday's price was not 265. There's some mistake there, so ignore that. Ignore the target price as well. I can see there is a buy call on this railway stock. Texmaco Rail is experiencing a remarkable recovery after the company faced a downturn in FY 23-24. However, the wagon business has ramped up to form an order accumulation of around 75% higher than its FY 14-22 orders. So it's a 228% return that the company has given in the last 1 year, magnified its capacity and anticipates reaching production of 1,000 wagons per month soon. Moreover, Texmaco's wagon rail EPC and OHE operations benefit from Indian Railways growth and metro projects. Nuvama's study stated that partnership with global firms increase in its rail component offers, assuring full railway services. Then this is about Texmaco only. It's got another order from Kamalau SA, almost approximately of 529 crores, 62,000, uh, 6 million. Yeah, it's about $62 million order worth about 529 crores in Indian rupees. The company shares surged 6% after getting this order. The deal includes supply of 560 open top wagons, and about 20-year maintenance contract. Along with it, it also opens the door for an additional 1040 wagons over 5 years with extended maintenance. So there is likelihood of getting an additional order of 1040 wagons with maintenance contract with it as well. It holds about a strong consolidated order book of 7,000 crore in Q4 FY25. The freight division leads about 40, sorry, 49% of the revenue book, followed by Infra Electrica 24 and others 14. 79% of the freight car orders come from the Indian Railways, while 21% are from the private sector and exports. Disclaimer, important disclaimer. This article comes information extracted from different resources on the internet. All investment opinions and recommendations mentioned are solely those of the respective expert broking houses, rating agencies. These views do not reflect any personal opinion or advice. Market investments carry inherent risk of financial loss. Investors must exercise their own judgment and conduct proper due diligence. The author bears no responsibility for any losses resulting from the decisions based on this article. It is strongly recommended you consult a qualified financial broker or investor before making any investment decisions. Thank you. We will go through some information here. Right. Just a moment, friends. Some of the stuff is just loading. Okay, we'll start with Texmaco Rail and Engineering. This is the logo of the company. 11.5% up in the last 1 month, 9% negative returns in the last 6 months, and overall a 28% negative return in the last 1 year. It's a part of the Advanced Group involved in business of manufacturing rolling stock, hydro-mechanical equipment, steel castings, and construction of rail EPC and other steel structures. Current price 179, high of 297, price to earnings of 28.6, book value 70. So company is trading at 2.5 times its book value, dividend yield of 0.28%, return on equity 9.3%, return on capital employed 14%. Face value 1 rupee, 26.6% CAGR profit growth in the last 5 years. Low return on equity of 6.45 in the last 3 years. Shareholding decrease of promoter by 10% in the last 3 years. Peer comparisons, a low of 28 to a high of 211. So you can see the different price to earnings ratio of the different companies. There's a huge variation here in terms of market cap. Texmaco is the lowest with 7,000 and Keynes Tech 39,000 being the highest. You can see sales. Apart from that first second quarter growth, there has been stagnating revenue. Net profit reduced in the last quarter, which is not a good sign for the company. Then overall sales year on year, almost 40% growth, 43% growth, which is a good sign. Net profit grew by 120%, which is also a very good sign. You can see sales growth 46%, stock price growth of minus 28, return on equity has been the best in the last 5 years, 9%. Equity capital remains 40 crores, borrowings have increased substantially, reserves have grown by about 250 crores, which is a good sign. Debtor days have increased, inventory days have reduced, which is a good sign. Days payable have reduced as well, which means that the company is able to pay its suppliers and creditors uh, earlier than in the previous years. Cash conversion cycle has gone up, which is a sort of cause of worry. Working capital days have reduced, being the best in the last 5 years, so which is a very good sign again. So less work in progress and more quicker turnover in terms of delivery, which would directly improve the revenue generating capacity and would reduce capital stuck in work in progress. So promoters 48%, FII is 8%, DII is 8%, public at a high of 35%. So again, high public holding can relate easily to uh, variation in price in terms of price volatility and in volatility in terms of the volumes traded on the stock exchange. So friends, we'll now look at the other PSU, which is Ircon International. Here, this is the logo. This is one of the workshops of the company. Then another uh, Ircon logo with a train engine or a train. Then currently 4.3% return in the last 5 days, 6% in the last 1 month. uh, 5% negative return, sorry, 2.3% negative return in the last 6 months, minus 24% return in the last 1 year. So again, October November correction led to the drop in the price of the stock price, giving an overall negative return to the stock. Then we've been through the basic information of the company: current price of 204, high of 352, price to earnings ratio 26, book value 67, company is trading 3 times its book value, dividend yield is 1.52%, return on equity is 12%, return on capital employed is 12% as well. Face value is 2 rupees, debtor days have increased to 45, promoter holding decreased by 8% in the last 3 years. Earnings include another income of 431 crores, healthy dividend payout of 34.2%. Here comparisons, and you can see revenue in the last quarter has grown by about 800 crores, which is a good sign. Overall, about 25% revenue growth in the last 1 year. Net profit is stagnated, should have improved, which again doesn't go well with the sentiments. Overall improvement from the previous quarter back to the levels that it managed to get in the June and September quarter. Basically a recovery period. Then you can see sales to 1.5 1,500 crore drop in revenues year on year, and about 200 crore drop in net profit year on year. So not a very great sign overall. This is going to dip further. However, if the company is able to generate a good amount of net profit even with a lower revenue, still there is a chance of good value addition in the long run. However, that seems to be unlikely. So something that you need to be very careful of in terms of uh, investment at this point of time in this company. If you're holding, please consult a financial stockbroker to see what is the kind of input that they can give you, whether to hold, whether to exit the stock, uh, and what sort of future net revenue profit growth that the company is looking at. Uh, Reserves have grown by 450 crores, which is a good sign. Borrowings have drastically increased, which would lead to higher interest costs and higher, impact on the overall net profit of the company. So, which is not a good sign again for the company. One, revenue is dropping, net profit is dropping, borrowings have increased, chances of managing the net profit from meeting the previous years, data would be difficult to match. Data days have increased, cash conversion cycle has improved, which is a good sign. Inventory days have reduced as well, which is a good sign. Days payable have also reduced, good. Though the return on capital employed has dropped from 16 to 12%, from 18 to 12%. Promoter holding 65%, FI is 4%, DI is 1.5, government 0.28%, and the public holding stands at 28%, which is still all very high indeed. In terms of any negative sentiments on the stock, it definitely will impact the overall price of the stock, and the volumes traded on the exchanges would easily go into the oversold zone. So friends, thank you for watching. Please share this video with your friends, family and associates so they could all benefit from this information. Since Wish you a happy weekend, and we'll connect with another video very soon. Thank you.